Kia ora. Hello. Haere mai. Welcome back. Ki te pehe koe. How are you? Hope you're well. We're at part 2 of our topic on costs, and now what we're going to do in this section is to categorize costs in a couple of ways and then do some calculations. So let's go. Now, our first difference or differentiation of costs into two groups is going to be that accounting costs are not the same as economic costs. Even though economic costs include accounting costs, but there are other costs that are also added. So in this way, economic costs are always going to be greater than accounting costs. So we use two terms, explicit and implicit. Explicit costs are all the costs you would associate with producing or supplying a good. So when you think of firms' costs, you think of electricity, wages, equipment, etc. Explicit costs, obvious costs, or accounting expenses. But when an economist looks at costs, he also calculates the opportunity costs or implicit costs. These costs are implied. And so, for example, a business when, like ACG, that buys this building and it borrowed the money from the bank to buy it, will pay interest and explicit cost on the loan. But when ACG decided to use this building for its own business, for providing education, it gave up perhaps the next best opportunity, which would be to rent the building out. So that income or money, rent that was lost, is considered to be a real cost. And so when economists add up their costs, they add up their explicit costs and their implicit costs. So economic profit is total revenue or accounting profit, we should start with, which is total revenue minus accounting expenses. But then we have to subtract opportunity costs. Or another way of looking at it, economic profit is total revenue, P times Q, minus total economic costs. And of course, total economic costs are accounting expenses plus opportunity costs or explicit costs plus implicit costs. So in this way, accounting profit will always be higher than economic profit because accountants don't take into account opportunity costs. So let's take this simple example of a teacher who gives up teaching to set up a business as a lawn and cutting grass, a lawn mowing business. So he takes $50,000 that he's got in his savings in the bank that was earning 7% interest a year, and he puts that money into his new business, set up, vehicle, equipment, etc. He also gives up a salary that he was getting as a teacher of $60,000. So immediately we've identified two opportunity costs. Now, if this was an accounting calculation, this is what it would look like. The income or revenue generated was $90,000. His expenses, explicit cost, $30,000, so his profit would have been $60,000. So on the face of it, from the accounting point of view, good business. It's a good first year's profit. The economist, though, wants to look at these implicit costs, the costs that are very real but ignored by the accounting process. And we have identified them as the salary he got as a teacher, as well as the interest he would have got if he left the money in the bank. So in effect, his total opportunity cost is $62,500. So when you put that with the explicit costs, then you see you end up with negative profit that is below zero, subnormal profit. So the economist comes out with an answer that's significantly different to the accountant. To summarize, accounting costs are always less than economic costs because economic costs include both the accounting costs, expenses, plus the opportunity costs. Economic profit will always be lower, therefore, than accounting profit. Now, another way we can categorize costs is dividing total cost into fixed costs and variable costs. Add them together, of course, they equal total cost. Now, when we look at this word fixed, of course it means does not change. And when we look at the word variable, we can also know that it means does change. But it's important to underline that fixed costs do not change as output changes. The variable costs change as output changes. So in the case of fixed costs, they're independent of output. So the firm can be producing nothing, but still be paying fixed costs, while variable costs only change when output changes. So when we look at the examples, we can see first wages and salaries. And many students say to me that, well, when you're employed on a salary, it's fixed for a year, but you have to take a different point of view and underline again the importance of the second part of our definition as output increases. Now you take ACG, and as more students come, output increases. More students increase quantity. So ACG, therefore, will have to employ more teachers to teach these students. And so output is increased and therefore costs increase. So wages and salaries are a fixed cost. Electricity is the same. More students means more electricity is going to be used, so variable cost. In contrast, insurance on the building is independent of how many students are in the building. If all the students are on a holiday or they're not here, what that means still for ACG is they have to pay that insurance on the building. It's independent of how many students actually in the building. Fixed cost. Petrol, not a very good example for ACG, but you can imagine as more students came in, and if ACG sent someone out to collect them from the airport, well, more students, more petrol, so a variable cost. Equipment, of course, more students means more equipment, more tables, more chairs, more iPads, etc. Variable cost. Toll-calls, more students coming here means ACG will be probably doing more calling home in China. So remember, a toll call is a call outside the region. You have to pay for it directly for the minutes that you use. So more students, more toll calls, so variable. The line telephone rental, fixed, because it doesn't matter how many students are in here. Basically, the cables come in, and whether there are 100 students or 1,000, ACG will pay for that rental. Again, similarly, rates, which is a property tax. If ACG owns this building, it will be paying rates, and this amount is independent of how many students are in the building. Fixed cost. And interest payment on loans, again, fixed cost, because ACG borrows the money to buy the building. Whether there are any students in the building or 1,000, it still will be paying that interest. Now this slide is simply to help reinforce the relationship between total, fixed and variable costs. Of course, the horizontal line is fixed cost because it doesn't matter whether you're at 0 output or 50 units of output, the firm still pays $1,000, hence the horizontal line. Remember, fixed plus variable equals total. So the variable cost is always going to be less than the total. It's important to note here that this value here represents 1000, and of course this gap here represents 1000 because the difference between total and variable cost is fixed cost. So the value has to be 1000. So looking at the questions underneath, what's the difference between total cost and fixed cost? Well, it's variable costs. And likewise, the difference between variable and total cost is fixed costs. Secondly, why is the fixed cost curve a horizontal straight line? Because they're costs that are independent of output. They don't change when output changes. Thirdly, what is the value of fixed cost when no goods are being produced? 1000. And what is the total cost of producing 50 units? Well, it's 9 plus 1. And now we've arrived at a table that I'm going to get you to complete. And what you need to do is look at the top column and identify the relationships. Remember, Q, of course, is quantity or output. And you've got up to 7 units of output. And what you've got to do is actually find the correlation between, for example, these three. And you know, total variable cost plus total fixed cost equals total cost. And then you can see another correlation between average fixed cost plus average variable cost equals average total cost. And then marginal cost, of course, is calculated by looking at the change in total cost. One more thing, when you look at the table, you actually have to find one particular number first before any of the other numbers can really be calculated and the table to be completed. So it's this number here. Once you find that number, then you can solve the whole table. And so there are two ways from the information presented. One is by taking the average total cost and multiplying it by the quantity, because the average cost is equal to total cost divided by quantities. So by simply rearranging the formula, you can calculate that it's going to equal 100. Conversely, you also know how to calculate marginal cost. And so rearrange your formula, and you know that the total cost of the previous unit, the second unit, is equal to the total cost of the third minus the marginal cost of the third, which equals 100. Once that's solved, then of course you can work out the fixed costs. 80 plus what is 100? Of course it's 20. And then you know fixed costs don't change when quantity changes, so now you have that column completed. At zero output, you know there are no variable costs, so you can work out the value of total costs here at 20. Likewise, you can now add across here to get these two values and complete the total cost table. Once you've done that, you can work out average fixed cost, which is total fixed cost divided by quantity. Then similarly, you can work out average variable cost, taking total variable cost and dividing by quantity. Again, average total cost, you can either add across AFC plus AVC, or you can simply divide the total by the number of units. Marginal cost, remember, is the change in the total. It's linked directly to this value here, and we're measuring the change. It measures the rate of change, or the gradient of the total cost curve. And so there's our table complete, and if you had any trouble with it, just review it a couple of times and work on it until you feel confident. Now, a useful exercise, of course, is to actually plot the graph, and then you can see how the average total, the average variable and the marginal cost curves relate. Now, in the past, there were a number of questions asking about these relationships, but now the most important thing is that you remember how they're related. So you won't be asked why they're related in this way, but you have to remember to draw these three curves in the same way. So average total, of course, is going to be there, average variable is going to be below, and the marginal cost curve, if you have looked closely, you will see it always cuts, it always intersects the lowest point of both the average total and average variable cost curve. So when you draw them, it's really important that you make sure the MC curve intersects the lowest point of both these curves. You can also note there that the gap between average variable and average total, as output increases, gets smaller and smaller. The distance gets smaller, and we'll address that in a moment in the next slide. A couple of more points, relatively obvious. Remember, total fixed cost doesn't change, so hence the horizontal straight line. But of course, the average fixed cost will always decrease as output increases. Remembering that the total value doesn't change, but when quantity increases, of course, the average decreases. And so average fixed costs will always fall as you produce more. The average variable cost, of course, therefore will rise more quickly. And this helps explain why the gap between ATC and ABC represented there, that's ATC at that quantity, that's ABC at that quantity, and the difference has to be, of course, average fixed costs. And the question is sometimes asked, why does the gap, the distance, get smaller between ATC and ABC when output increases? And the answer relates to AFC. You know, as output increases, average fixed costs decrease. So that means average variable cost must increase. You may have noticed when you plotted the marginal cost curve previously that it resembles probably the Nike tick or the Nike tick. And so what we're going to do is explain the shape of the curve and use the reasons to actually help explain how we derive an individual supply curve. But firstly, let's remind ourselves, marginal in economics almost always means the extra cost of producing another unit of output. Marginal cost measures the rate of change in total cost, calculated by the change in total cost 1, minus 0, 2, minus 1, etc. Now remember, we're in the short run, and the short run is where at least one input needed by the business is not available, it's fixed in supply. And so this is important for determining the shape of the marginal cost curve in the short run. And remember, the marginal cost is the extra cost of producing another unit of output. Now, we notice first that as output increases initially, marginal cost decreases. And we know if marginal cost is decreasing, that marginal output is increasing. So we can talk about marginal cost falling initially because of increasing returns. Marginal output goes up. It reaches a low point, as we can see here, just beyond there, and after that, marginal cost rises rapidly. So as you produce more units, marginal cost rises. And the reason? Because marginal output must be decreasing. And if marginal output is decreasing, we know, or we call that, diminishing returns. So very much the explanation for the shape of the marginal cost curve is about increasing returns and diminishing returns. Once again here, this is highlighting the relationship between the marginal cost ATC and ABC, and we can see that the marginal cost curve intersects the lowest point, always the lowest point of both these curves. As it says on the right hand side, students are not required to explain why this occurs, but you must always draw the curves like this. Failure to do so will mean immediately you'll lose 1 mark, so please remember.